Hello, Chart Watchers, and welcome to this Monday, April 30th Market Watchers live show with your hosts, Tom Bowley and Aaron Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. So right now, we got the Dow Jones Industrial Average currently up 45 points. The S&P 500 is now down 4.6 points. The NASDAQ has turned lower by 25 points. The Russell 2000 down 3 points. 10-year Treasury yield moving lower today, down a little bit more than 1 basis point to about 2.94%. Volatility index earlier today down near 15, but it has moved back up with the recent selling, and the VIX is up 3.5% today to almost 16. The XLY, consumer discretionary, one of the better performing areas of the market today, up about 30 cents. You can see the XLF also up slightly, one of the best performing sectors in the market. Materials definitely weak today, down about 0.3%, and the recent rising dollar not helping there. Restaurants and bars among industry groups having a very nice day as McDonald's reported better than expected earnings. You can see McDonald's making a multi-month high on those results. On the flip side, in the diversified industrials, Arconic, ARNC, down more than 16% on weak earnings. And with that, let me bring in my co-host, Aaron. How are you doing, Aaron? I think you may still be muted.
I'm doing quite well. Looks like we may have some rain coming up here in a few days.
Uh-oh.
Interesting.
Yeah, that doesn't happen very often. Did you have a good weekend?
I absolutely did. I'm going to send a shout out to my mom, whose birthday it actually is today. Happy birthday, Mom. And we spent the weekend over there. We had a great Saturday, Sunday. Yes, and we talked a lot about the market, honestly. I mean, we generally keep it to a minimum, but we had a lot of discussion about where we stand as far as the market's bearish, bullish, and he's put it the flag up. I mean, he's already said, yes, I'm going to say that we're at the beginning of a bear market. So he's stepped out there on the ledge and taken the jump. Me, I think he's on the right track, but I'm not ready to state it yet. I told him, I've watched a lot of bull markets, but I haven't watched too many bear markets. And yeah, this doesn't feel right to me, but I need some more information.
Well, it's certainly been a volatile last couple of months, no doubt about it. I'm not in that camp for sure. I still think we're in a correction, but time will tell. It's going to prove one side or the other right.
Yes, eventually.
All right, I'm going to let you go ahead and get into the schedule and the agenda for today, and we'll get into all the action.
Absolutely. So we've got a big week coming up. Tomorrow, I'm going to be doing, instead of my DP report today, I'm going to be doing a monthly decision point report tomorrow. I'm going to go over all those monthly charts, so that'll be a lot of fun. Tom McClellan is going to be with us here on Wednesday. Lots of interesting information there. I know he's been quite bearish. Bruce Frazier, Mr. Wyckoff, will be joining us on Thursday. And so it should be a great week. We're really looking forward to it. And I know you should be too. Today's agenda is really jam-packed, of course. We've got Monday setups to start off the program. And Tom is going to do a special seasonality report today and give you the information you need going into May. As far as seasonality, 10 and 10 to 1, our first symbol is going to be Donnelly R.R. & Sons, and that's RRD. So if you want to go and check the chart out now. And finally, we will finish with Anatomy of a Trade. And that's the great agenda we have in store for everybody. So go right on ahead and let's get started with some technical news, Tom.
That psychological 3% level last week, it was on Wednesday. We closed above 3%. And for those of you who maybe haven't been paying attention, if you go back over the last few years, I'm going to pull up a long-term monthly chart on the TNX. But if you go back to 2014, we haven't really seen yields at this level. At least the 10-year Treasury yield has not been at this level since back at the beginning of 2014. And I think it's a pretty significant level, too, because as you decline, it's typical to have lower lows, lower highs. Here, we've come all the way back up to challenge this high with a double bottom in play. So I think a breakout here above that 305 area that we posted back in early 2014, I think would be very bullish for the yield, bearish for Treasury prices in general. And with a breakout and actual technical selling taking place in Treasuries, a lot of times that will coincide with a nice move to the upside in the equity markets as well. But we'll wait to see if that is the case. But we do clearly have an uptrend in play, I think, off of that midsummer 2016 low. We bounced off of it, pulled all the way back to the 20-month moving average, and then broke out again. But that overhead resistance at 305 is going to be very important, and there will be a lot of technicians and fundamentalists as well that will be watching that level. I do want to bring up again a chart that I've shown many times before because I think that it's playing out exactly as we've discussed. The 10-year Treasury yield here in the U.S. compared to the German 10-year Treasury yield has been rising for many years. So this doesn't tell us that necessarily the 10-year Treasury yield has been rising for 10 years because it hasn't, but it has been rising faster than what we've seen in Germany. The rates on a relative basis have been increasing. What that normally means is that when rates in the U.S. are going up faster than other parts of the world, normally the dollar rises. And as you look at this chart and you look at the dollar and you look at the correlation, you're going to see that for the most part, the dollar does follow the 10-year Treasury yield here in the U.S. relative to Germany. So when that's rising, you would expect the dollar to go up. And that's what the correlation tells us. Most of the time, it is in positive territory. But we recently just experienced our third pretty significant negative divergence or negative or inverse correlation where the dollar has not followed the rates in the U.S. relative to Germany. And you can see the prior two times that this happened when the U.S. rates were going up faster than Germany, happened back in 2009, happened again in 2013, 2014, with the dollar declining during both of those periods of rising yields. We came out of that with a surge in the dollar to the upside both times. And in addition, P500. And that to me makes perfect sense because when you got a dollar rising, those companies on the S&P 500 are multinational companies, and a rising dollar cuts into earnings, at least any of the earnings that they do overseas. So you could have foreign currency translation problems there. But what we've seen recently is the dollar over about a 15-month period declining. And it was fine when we saw the yields declining here in the U.S. relative to Germany. That is what we should expect. But we actually bottomed in that. We started rising again on the yield, and yet the dollar kept moving lower. And that's what generated this negative or inverse correlation. And now we're starting to see that turn back up again. See what we did before? We had this huge move back up into positive territory both times. Looks to me like this is just starting to the upside. That could be the beginning. This could all mark the beginning of rather significant outperformance by small cap stocks. I just want to post, and update you on that. As far as some of the economic news, we did have a couple reports out this morning. March personal income rose 0.3%. The market expecting 0.4%, so a little bit of a miss there. March personal spending matched estimates, rose 0.4%. April Chicago PMI came out at 57.6. Market looking for 57.8, so pretty much a match there, just a slight miss. But March pending home sales did fell short of expectations. It actually rose in March 0.4%, but the market was looking for a gain of a full 1%. And what that has done is put the home builders on the defensive today. You can see the home builders, after putting in that long tail on Friday, trying to break out above, move to maybe a 3-week high. We did fail, and now we're coming back down with this bad report. Just more sideways action. I do think, though, the 800 level on the home construction index is very important. You can see it here on the daily chart, but even more importantly, I think when we step out, look at the big picture weekly chart, you'll see we had this huge move up. We came down, we tested the 50-week moving average for the first time in more than a year. We hadn't done that since back in January of 2017. You can see that for the first time in a while. So a breakdown below 800 not only would take out the support that we were just looking at on that daily chart right here at 800, but look at where the 50-week moving average is right now. It's at 806. So we start to move much below 800, we're losing price support, and the 50-day moving average, we'd be trading below it for the first time in quite some time. So that's something to keep in mind on the home construction group. Let's take a look at a couple of the major indices. Actually, I'm going to focus on the NASDAQ. Let's take a look at the NASDAQ. Now, when you look at the daily chart, to me, this is just a trendless market that we're in right now. We had a huge run up into January. We did initially make a little bit of a breakout, but you can see this was an island cluster reversal, made a big move up. We gapped up, consolidated in this cluster, gapped back down, left all those candles up there on an island, came back down, but held the prior low. And we saw the same thing on the S&P 500. So I think we're sideways consolidating here, which makes it very difficult to trade on more than just a very short-term basis, because these trends that we see to the upside and to the downside don't seem to last for a very long period. So if you're holding, thinking you're going to hold, you get into a position you think it's going to work out for several weeks, probably not in this market, not until we break out or break down. As far as the hourly chart goes, this is what I'm keeping an eye on, because I think once you get into sideways consolidation on the daily chart, I think your trends are established on the hourly chart. And I do not like what is going on right now. We are breaking back down below that rising 20-day moving average. Actually, looks like the 20-hour is beginning to roll back over. We have some gap support at 70.75 right in here. If that doesn't hold and we're just about there, we could be looking at 7,000 again, which would be the bottom of gap support from last Wednesday, from what last Wednesday's close, I should say. So let's see, what else do we have? Well, a couple of things. We've got volatility index, which is always worth watching. Volatility was threatening to break back down below that March low. The VIX 13, but so far we are holding it. The VXN, which is basically the volatility index for the NASDAQ 100, also has been on the move lower. We saw that short-term top with those tails. Pretty sure we talked about that last week on the show. The VXN did come down as we made a little bit of move to the upside, but so far we've got lows that have been holding, and right now we're trying to make another push back to the upside in the VXN, which is not good for the overall. $4 billion versus 4.93 billion. Bottom line, they beat 179 versus 167. And this is a nice looking candle if it holds up into the close. We got a lot of volume coming in. We've cleared a key level at 164 where we had not been able to clear for about 3 months. And so with heavy volume, if we can close near the high, if we take a look at the restaurants and bars, this is one of the better looking, or at least one of the better performers today in terms of industry groups. You will see that the restaurants and bars did the same thing, breaking out above the recent highs, starting to show some nice strength, although it is at the low of the session. Not a good thing. We'd like to see that pick back up again before the end of the day. One other renewable energy, DW Cree. And when you look at this, look at the false breakout. We talk about this a lot on the show. I don't like to see these tails where it looks like intraday we had such a great day going, breaking out above prior highs, moving to multi-month highs, and then we fail at the close. And look at what has happened to this group today after making that failure. We were up over 120 during the day on Friday, and now we're back down to 108. That's a 10% drop literally in a day from Friday's intraday high. So not good action on the renewables here. I still think the overall uptrend's in play, but short term, this low from Wednesday around 107.5 is coming into play, and we'll see whether or not we can hold that. And with that, I am going to turn it over to Aaron. I do want to mention, though, Apple reports earnings tomorrow night. A couple of big reports coming up this week. Most of the big ones have been are in our rearview mirror, but we do have a couple in technology. We have Akamai reporting later today, Apple tomorrow, Gilead reports tomorrow, a couple of the pharmas, Pfizer and Merck, and then Wednesday we have Tesla. And with that, Aaron, take it away for the
We often go in here to the downgrades and look for bottom picking if something looks good. And I'm going to tell you, I looked at all these charts, and even the upgrade here did not look good. So I'm just going to go right in with, I don't like these charts very much. So you can see if you agree. Anyway, Colgate-Palmolive, one of the downgrades today. Clearly, this is an area of the market that has been struggling in consumer staples. I wanted to look on a weekly chart because I need to know where some support is here, because as far as the year goes, we're testing those lows. So I'm going to take us to a weekly chart so we can get a better idea of what we're looking at. Now, obviously, I'm looking at this OBV, and of course, the PMO doesn't look good on the weekly chart. I see that there is some support here at about 67.50. Support would possibly be back here the end of 2016, early 2017. Those lows right around 62.50. So I think you'd be, crossing those fingers and hopeful at this point, but I wouldn't be even in to begin with. And of course, if you are, hopefully you got out at that 67.50 level. Downgrade, another one, JetBlue Airways. It's at least come down. There's a little bit of possibility for support back here at the September low, and it did pop off of this low from late September and into October. So it may have found some support here, but I'm looking at a PMO that's still trending lower. The OBV is not making, it doesn't look impressive at all, nothing good there. So I don't see JetBlue at this point as a possible play on a downgrade, but you can see we are very close to some intermediate term support just below, just about at 18. So, if you want to make a play off of the support level, you could certainly do that. But when I look at momentum in the OB, better selections out there than trying to make that trade work. We have Wayfair. It's now sitting on some support we saw earlier in April at the beginning. But look at this PMO turned down below the zero line. Pretty ugly setup here. I don't see anything that I would be interested in on this downgrade. I suspect it has a bit further to go. But we do have this area of support back here at about 55, and it lines up right around here at that gap support. So it's certainly an area for support, but at this point with that gap down, it looks like a breakaway gap to me. I would expect more downside. As far as upgrades, Altria Group, MO. And, with the PMO on this one, I mean, at least it's starting to decelerate and think about turning up. But this is another one where for the year, I can't really see any support levels. And this is on an upgrade. So I'm going to look in here at the weekly chart because does this look as a good possibility? I just don't see it. We're sitting on this level. I don't really see much support there. I mean, you could make, again, a case at 57.50, but we already dropped below that. The next level of good support I see at 50. So on an upgrade, you certainly could see a bounce off that 55 level, but it doesn't look good to me, even on the upgrade. The other upgrade we have is Take-Two Interactive Software. This one I thought did have some promise, but I'm not in the business of getting in the market right now. But this has some pretty decent possibilities. You're on the PMO buy signal. I came in oversold territory. You can see that the bottoms are moving just a bit higher here in tune with the PMO. There's some important resistance, though, we need to get over here at about 102 or 105 that line up with these support levels here at the February low, the December low from 2017. Looks like we might be able to get up above that 200-day. But at this point, I would want to see it trading above that 200-day solidly on a PMO rising. We don't quite have that yet, but I think Take-Two, there's a little bit of possibility there. And Wells Fargo actually doesn't look too bad. It's on the PMO buy signal. The PMO is trending up. It's actually started to accelerate on that gap that brought us up there. You could make a case for a flag. At this point, I would be watching that 54 level, that area of overhead resistance. I'm not so sure this is where you want to get in because I think the risk to the reward isn't very high just yet. I also see a 50 below the 200. So I think you could add this to your watch list. It's set up okay. But I don't trade anything with a 50 below the 200 unless I'm going for a short. So typically you're not going to see me get in at this point, but you can see that 5-day EMA is just about ready to cross that 20. So it's not looking too bad. So not horrible as far as our upgrades and downgrades, but I have some Monday setups that I think look way better than these upgrades and downgrades. So with that, I think I'm going to go ahead and get started on those Monday setups. Tom, I know you're getting ready for your seasonality, so I'll just hit these and then pass it back to you. See what you have.
Okay.
All righty. So let's see what happened recently, though. What happened last week? I went in with Square, pretty much got in right before it went and hit a decline. My stop was hit at 49.50, like the very next day. And I mean, if I had been in, I don't even know if that stop would have happened. It was that was the day where it just went down quickly and in a bad way. So I know right now, let's see. And you had Nike. So let me go and let's look at those charts. Okay, actually, I'm going to go here because I have my Monday setups here. So let's go look at the other one. So there's my pick of Square. And seriously, I think I picked it right up here. We had 2 down days, one that followed that, like I said, brought you way below that 49.50 stop. So kind of ugly. I don't know when the stop would have been triggered given that deep decline for that day. But we are making a little bit of a move back here for Square. It's back up here at the support level. PMO doesn't look as good. It certainly was looking good on its way up for a positive crossover, but this is a great example of how a good setup, momentum looks pretty good, and it doesn't do what it's supposed to. Now, how about you, Tom, with Nike?
Yeah,
Much better choice.
Yeah, it looks pretty good. I was looking at it on the chart here. I actually did trade it, but I got out when it got up near the resistance level. I still like the chart, though. I think this is a nice bullish ascending triangle.
Mm-hmm.
You know, we've got equal tops going across at about 70. The last couple of lows, you can see the bottoms starting to move higher. So I think that Nike's going to break out. But I like to respect resistance, especially in a choppy market like we're in right now with a lot of the back and forth. You just don't see as many breakouts. And when you do, sometimes you get false breakouts. And it was trying. I mean, it got up to 70. I think it may have even peaked a little bit over 70 on Friday before we came back down today. But I think the rising 20-day could hold. If that doesn't hold, then maybe I'd be looking at that trend line that probably intersects around 66.5. But yeah, yep. Overall, Nike did pretty well last week. But again, I think you have to respect resistance in this market.
No, I think that was definitely a great play. And I agree. When we're sitting in an uncertain market, that's certainly what I would want to be doing.
All right, what do you got for this week?
All right. So I had to take Intel off. I actually had that on there, and I almost took, I think it was Mellanox off, but I'm going to leave them because this is what happens. You know, you run an intraday scan, you're going to get certain results, but then when it comes back later, I'll probably run it just real quickly for everybody to see if I got any others that were new. My pick, I think I'm going to go with Immunogen. I usually don't get involved in that biotech space, but I really like the setup on Immunogen. But let's go see what the other ones are. Bloomin' Brands was one that came up, and you can see that PMO has just started to turn up. We've got some new momentum. Look at the volume activity here. We got that nice big breakout on the OBV. Of course, you've had a nice scooter that's been in the hot zone since mid-February. So I did like this particular Monday setup. I'm going to just throw an annotation tool here. This chart's a little blurry. I apologize. I'm not sure why. So you can see we hit that area of support. I'm looking really at that since I'm looking at this as a short-term investment, since that's what we do as far as the Monday setups go, I'm more interested in this 24 level here. Let's make that a little skinnier. And again, like I said, I apologize. I'm not sure why it's coming up a little blurry. But the main thing I want to show you is that at $24 here for Bloomin' Brands, we've hit some support. It's managed to hold that area of support fairly well at 24, just below 24, which is where it's trading. So I think this has some possibilities. The only issue is that risk reward, honestly, because you're looking at a downside potential that could go down to that 23 level. If I were playing it for the short term, I'd be watching that 50-day EMA as my support. But I didn't pick this one. Let's see here. Let's go. There we go. Now let's not save those. Dillard's. I'm not happy with the, there we go. I'm just taking it out of there because my charts were getting blurry. All right. So Dillard's I thought looks good. You know, you came off of this area at 72.50 for support, held it, is heading back up. The 5-day is getting ready to cross above the 20, which would give me a short-term trend model buy. We still have a 50 that's above the 200. The 20 is above the 50. So we're in a really nice trend model setup. And look at the pullback today. That's what made it kind of interesting for me because we got a pullback. You know, it's on its way down. It's down 1.8% right now, sitting at 76.62. And I think that's a pretty nice level to see it going back to. And look at that PMO bottoming and heading upward. So I thought that one looked like a pretty good setup. And Mellanox. And for those interested, I did take Intel off, mainly the PMO had turned down, and this is an example. The PMO started to turn down on Mellanox Technologies, so it came up as a possibility, but now the PMO is starting to turn lower, which would make me less interested, obviously. But you can see that we're backing up to this support level right here at that March high, which could form some nice support. If you look in the thumbnail, we've got a little bit of a bull flag in here. But I feel like this trade would be one I would be trying to convince myself to get into. So it is on my Monday setups, but it's certainly not as interesting as Immunogen. I think this one looks way more interesting. All right, mainly because there's just so many different target levels, and each one would really get you a pretty nice reward here. Risk, you're looking at a $10 stop here. I haven't put it in. Normally I put in what target is and what my stop would be. So you've got the PMO just about ready to have this crossover buy signal. The bottom is coming just above the 0 line. And somebody did ask me how you determine whether that's a good thing or a bad thing. As far as the 0 line, when you see oscillators oscillate above the 0 line, that implies internal strength to me. So while it's great to get these oversold PMO buy signals, I do like to see some oscillation here above the 0 line. So I think that setup is nice. I would be looking at targets at about $12 and $13. So it looks like I would be getting in at $10.90 right now with a stop. I would set it probably just around $10, maybe just a little bit lower than that. So that would be my pick for my Monday setup.
All right, that sounds good. I actually like it as well. And I tell you what, we're going to have an interesting battle this week. And we'll go over that in just a minute, but I'm going to first just show you. And I'm going to be talking about seasonality in a bit. So let's take a look first at the seasonality of the biotechs.
Tell me it's great.
I mean, it's not bad, actually. I mean, this isn't the best month. I mean, you can see biotechs tend to really do well in the month of July.
Wow.
And that's, I think part of that is that it is a more defensive, it's kind of the aggressive part of the healthcare group, but still kind of has those defensive characteristics when money's looking, to get away from some of the other aggressive sectors. So I think sometimes in the weak months like July, we do tend to see, money rotate a little bit. But you can see May and June are both pretty good months as well. So you got that whole go away in May thing that happens tomorrow. I'm not a big believer in it. I mean, the numbers don't lie. May through October definitely performs lesser than November to April. No doubt about that. I think history proves, backs that up. I just don't think the beginning of May is when you want to go away. I would say ordinarily it's more like the middle of July.
Right.
when it's time to fly. So you got to have
Yep, Carl was reminding me. He said, yeah, today ends that 6-month period of favorable seasonality. So
yeah,
take it away.
I think in the last Chart Watchers article I did, I kind of tried to dispel that, I don't know, theory to some extent, because from May 1st to July 17th, the S&P 500 has an annualized return, not an actual return, an annualized return of 6% for those 2.5 months. And so if you're going to take your money out of the stock market and it's averaged annualized, providing an annualized return of 6%, what are you going to do with your money? How are you going to top that? So
right.
I don't think that that's the right. I think the summertime, I've got the numbers to back it up, but I think when you get into middle part of July through the latter part of September, that's the real go away period in my view. But that's just what my numbers suggest, and there's a lot of other reasons why May works out pretty well, and we'll be talking about May in just a couple minutes. But anyway, there's your biotech seasonality, and the reason I bring this up, and the reason I said we're going to have a battle, is my pick is a biotech. So we're going to have a battle of the biotechs this week.
All right.
If the biotech index goes down, we're both in trouble.
There you are.
All right, I'm going with NKTR. And I know this one, you look at the chart, and it's really struggled of late. Stock was up to, I think, 111 at its high back less than 2 months ago. And now here it is sitting at 84. So what could I possibly like here? Well, a couple of things. I'm going to first go out to a weekly chart. And we had a huge move up. This stock it's seen a tremendous amount of accumulation. But you can see here on the weekly chart, it's pulling back and it's hitting its 20-week moving average. That's the first test that we've had off of this big move to the upside. So I think it's going to bounce off of this level, at least initially. That may just mean, a 5 to 10% bounce, but if that's what it does, that would be a pretty nice short-term return in a market that's really not doing anything. But I think the fact that it's pulled back, you can see we're so overbought on the weekly RSI. We're now back at 56, which is the lowest level we've seen in months in terms of the weekly RSI. So I think there are some possibilities there. But on the daily chart, going back to the daily chart, I'm going to maybe shorten it just a little bit here, just so we can see the candles and all a little bit better. But here you can see the selling that took place. Got us back almost to 80. And then back on Wednesday of last week, we went just below. I think these two lows have a chance to hold. You can also see that the trip back here right before the huge gap up also was in the low 80s. So I'm okay with, first of all, you have to understand it's a very aggressive pick. If you're not somebody that is interested in, trying to get a quick return, a quick pop to the upside with some increasing risk, then I would stay away from this. This is very aggressive, and I would say IMGN, the one that you went with, Aaron, is similar. I mean, they're both very aggressive picks. So for those back, trying to make sure they keep their retirement portfolio intact, I would be careful using these stocks.
Yes.
In your portfolios. But for those, again, that are more aggressive, I think both of these are very interesting. And I'm going to bring this one up, NKTR, in that relative chart. And I looked at IMGN using the relative chart and had very similar looking relative charts. So here was the move up, and here's the biotech. So biotechs have been under pressure, but they have moved off of the lows that we saw around 1850 a few weeks ago. But you can see NKTR has been struggling on a relative basis to the biotechs. But before that, I mean, you got to give them a little bit of a break because this stock had been such a huge outperformer. And then versus the S&P 500, it's been an outperformer. And it looks like it's starting maybe to turn back up again relative to the S&P. But biotechs prior to today, now, of course, I picked this morning before the market opened. But biotechs were starting to show some relative strength versus the S&P. That's fading a bit today, but I'm still going to bank on these relative lows holding. So if the biotechs begin to outperform, I would look to stocks that have been outperforming the peers. And I think when you look at NKTR and you look at IMGN, and I'll bring that one up as well, you're going to see very similar characteristics in that here's IMGN relative to the biotechs, very similar to what NKTR looks like. Here it is relative to the S&P. So even though biotechs relative to the S&P have been very difficult, it's been very difficult to outperform with these stocks. IMGN and Nectar both up until the last few weeks have actually managed to do that. So anyway, it's going to be interesting, but it's going to depend a lot on the biotechs overall. And with that, let's go ahead and summarize today's Monday setups. And so Aaron is going to go with IMGN, and I am taking NKTR. I'm going to call it the Battle of the Biotechs.
There you go. Here we are.
And actually, I didn't get a, oh, okay, there, 94.65 was the numbers. No, that's not right. It was just at 84.65. I think we have a typo.
84.65 then. Let's put it there.
Yeah, well, it's 84.73 now, so I'm up 8 cents. 84.65 is what we're going to go with.
Nice.
Anyway, so that's it for Monday setups, and we will now move into May seasonality. All right, well, first thing I just want to mention about seasonality is, for me, it's just for me, it's really just a tool. It's not, I don't trade off of seasonality. I use it to confirm other technical signals that I'm looking at. So if I happen to see, for instance, a stock or an index, an industry group that looks really good, just making a breakout or maybe testing a key area of support, then I'm going to be more interested in following that stock or index or industry group if, in fact, it lines up historically as well. So let me go ahead and bring up just the S&P 500 here. And the S&P 500, I believe, just looking at it technically as we head into May, I still think looks pretty good. I know that we've been consolidating, but hey, we had a huge move up. This market needed a period of consolidation. You can see the weekly RSI had gotten up to 90, which is almost unheard of. So I think this consolidation with the weekly RSI pulling back to 40 and 50, I think we're going to look back and see this as an opportunity. But again, could be wrong. 2581 is a big short-term, even maybe intermediate-term support level on the S&P. That's the recent low closes. I think 2581 is the lowest close. Here you can see an intraday move that went back closer to 2530 or so. So those are going to be some levels to watch down the road. Now, as we head in and looking at from a seasonal standpoint, I just want to mention a few things, and I'm just going to read a couple of numbers, and you can take notes, or you can just listen back to the recording later, whatever. But I'll just go without the charts for just a couple of minutes. The S&P 500 since 1950 has gone higher 40 times during the month of May, and it's gone down 28 times. So clearly it's gone up more than it's gone down. It averages, its annualized return for the month of May on the S&P 500 is just 2.84%. So that's not particularly impressive, and that ranks 8th out of the 12 calendar months. On the NASDAQ, however, since 1971, May is a little bit better. It's gone up 29 times, and it's gone down 18 times with an average annualized return of 10.88%. So much better. I think that's pretty strong return. And that makes May 5th among the 12 calendar months in terms of monthly performance. And then we get to the Russell 2000, which is even stronger. The Russell 2000 since 1987 has gone up 20 times during the month of May, has dropped only 10 times. So it is about a 2/3 chance, 67% chance roughly, based on history, that the Russell 2000 is going to go up during the month of May. And its annualized return, 14.36%, which ranks it 4th out of the 12 calendar months. So small caps tend to like the month of May. Now for an S&P 500 breakdown. I'm going to break it down by calendar period within the month of May. The 1st through the 5th, annualized return on the S&P 500 is 35.04%. So very bullish to start May, typically. The 6th through the 11th, minus 18.86% is the annualized return. So that kind of fits with the overall, during the year, 7th to the 10th is typically seen as a period of pullback or consolidation. So May kind of fits in. 6th to the 11th is bearish. I would say the 12th to the 16th is more of just neutral. Over the last 68 years, the 12th to the 16th has produced annualized returns of 3.33%. Then we get into another bearish period, 17th through the 25th, where the annualized return is a minus 17.65%. So really the 6th through the 25th of May, not particularly good. And then we get to the end of the month, and the 26th through the 31st, very bullish, has an annualized return of 35.37%. And all these numbers I give you on annualized returns of the S&P, you should compare to 9%. That's what the S&P 500 is average performing throughout the year over the last 68 years. So when you talk about 35% annualized return during the first of the month and the last part of the month, we're basically saying that the S&P typically outperforms its average by about 4 times. That's fairly significant over a long period of time like that over the last 68 years. Okay, let's talk about sectors. Leading sectors, and I'm going to show you some seasonality. This is where we'll talk a little bit about show you some numbers here. The XLP, believe it or not, during the month of May is the best sector, and you can see it over the last 20 years has gone up 68% of the time, and it averages producing 1.2%. For me, the reason is that May for the S&P is not really a great month. I mean, I said the annualized return since 1950 is only 2.84%. So if it's not one of the better months, that would tend to mean maybe money's going to rotate into defense. And as you will see here in just a second, that's exactly what happens. The XLP is up an average of 1.2%. If we go look at the utilities, this is the second best group in the month of May, averaging going up 0.8% during the month of May, going back to these last 2 decades. And then finally, I think it's the XLV, which also rises. Healthcare, this is the other defensive area. And in May, rises 0.8%. Those 3 sectors, consumer staples, utilities, and healthcare, lead all sectors during the month of May. And they are defensive groups. So it's typical for the market to kind of struggle during May a little bit, especially the big names on the S&P 500. And as a result, we see a little bit of outperformance in the defensive areas. What trails? I find this one to be very interesting, though. One area that typically does the worst, materials. And I think this is significant because we just saw a dollar breakout. So that's how I would say that, we want to be careful when we see things lining up. Now, May performance over the last 20 years is flat. But you can see when I go through, all the other sectors do have positive returns. So this is the only one that is flat during the month of May, and it is the worst performer, and that could be problematic with the dollar recently breaking out. Consumer discretionary is the second worst. You can see rising just 0.1% over the last 2 decades. And then finally, financials. Financials have risen 0.2%, I believe. Let's get a quick update here and see. Yep, there you have it, up 0.2%. So most of the groups, sectors, you can see really there's no real huge winner, no real huge winner. It's just kind of a boring, not so great, not so horrible month. So when we're looking at the S&P 500, those are some of the things to be thinking about as we head into or throughout the month of May. Let's talk about some of the industry groups. Well, we talked about the consumer staples being the best, so it kind of makes sense that one of their industry groups would be the best performing industry group in May. And it is, drum roll, tobacco, which has been absolutely horrible recently, but maybe we'll get a little oversold bounce, because in May, you can see that tobacco average is going up 3.9% in the month of May over the last 19 years, and it's gone up 72% of the time. That's pretty significant numbers to be watching. So at this point, I would say tobacco is certainly an area to look for, maybe just for a bounce, if nothing else. And we could pull up that index real quick. But here's what I was talking about. This does not look good technically, but look how oversold we are. So maybe because May is a good month for the group and the market is turning a little bit more defensive, we've seen the gains early in the action like we saw on Friday. We reversed. Maybe we're going to see a little money rotate toward defensive groups. We are starting to put in higher highs and higher lows. This is the second day of that after a huge decline. So maybe tobacco is setting up for a little bounce here in May. Another group that is strong, this one might be a little surprised since it's not in one of those defensive groups. Internet stocks tend to do pretty well in the month of May. Average return, 3.6% over the last 18 years, and you can see it goes up 69% of the time. So internets could continue to do well. Well, I shouldn't say continue to do well. They've been struggling recently, although I think over a longer period of time, clearly they've been a great part of this bull market. And one more group that I wanted to point out for May that has done pretty well, and I think I saw Mattel was doing well earlier today, but there you have it. Toys have risen 78% of the time in the month of May, averaging 3.4% gain over the last 19 years. So this is a pretty strong month typically for toys. Lagging, what doesn't work typically in May? Well, training, employment agencies, business training. This group tends to struggle if we go back. Now, this is only 15 years. It doesn't go back as far as some of the others. But you can see it only rises 46% of the time. And we do have 2.8% average decline. And when you look across all the months, this is the worst month of the year for business training and employment agencies. Autos. Just talked recently about how strong April tends to be for autos. Well, that is not the case for May. You can see April very strong. May drops off, only goes up 39% of the time, and averages declining 2.5%. And then finally, and I think this one's going to be kind of interesting, home construction. Home construction, you know, from a common sense perspective, you'd think, you know, as you head into spring, that you would do pretty well. But actually, look at the May returns along with June. These 2 months are not good for home builders. And some of the months that you would think would not be good at all for home builders, November, December, and January, are the 3 best. And this goes back again over 19 years. And you can see on a percentage basis, November, December, and January are first, second, and third in terms of the number, the percentage chance that those months are going to go higher. And we get into the warmer spring months, and actually things start to tail off a little bit, as you can see. All right, finally, I'm going to look at some individual stocks. And what I've done, and this is a pretty interesting feature here at Stock Charts. So I'm going to go back to the dashboard. And down below with your chart lists, you can view any of your chart lists as, you know, you can pick. So for instance, the Dow Jones 30, if you view as seasonality, they're going to come up one at a time in seasonality. Now they come up as, you know, default 5-year, but here is the 20-year. You can just stretch it back. This is Apple. Apple hasn't been bad, up 1.6%. But when you look at it relative to all of its other months, May is not one of the better months for Apple. But I'm going to give you some that are. And by the way, you can just click through this list one at a time. So if you have a chart list and you want to see seasonality, just go to that member dashboard down at the bottom and go down to the actual chart list and just say view as, click seasonality, and they'll come up. And you just do it one at a time. If you want to drag it back 20 years, you just grab that little slider, drag it back. Here's American Express, not bad, 1.2%. Goes up 63% of the time, and then you just go to the next one. So you can quickly go through 30 Dow charts if you have a chart list with those stocks in there. But let's take a look at some that really do well. And I'm not going to compare later. Let's go. I already have these already gone through. So let's take a look at Coca-Cola for seasonality. You can see it goes up 68% of the time during the month of May, and average is going up 2.4%, which when you look across, trails only October over the last 2 decades. May is a pretty strong month for Coca-Cola. Travelers. Travelers tends to be a very strong month. Or tends to perform pretty well during the month of May. Only goes up 53% of the time, but you can see it averages going up 1.9% during the month. So, and remember, we just went through all the sectors. The top sector was only 0.8%, consumer staples. So any of these that are, you know, over 1% or 2% clearly outperform during the month of May. UNH, United Health. 2.3% a month of May. Look at that. Goes up 74% of the time. And then finally, Visa. We already talked about American Express earlier, but Visa also in the month of May. Here you can see averaging almost 1%, going up 80%, but there's only 11 years here on Visa. So keep that in mind. I like the more history we have, the better I like it. So what doesn't work during May? Caterpillar. We talked a lot about Caterpillar. I've been pretty bullish, but check this out. Caterpillar over the last 2 decades only goes up 32% of the time in May, and it averages declining 2.5%, making it the worst month of the year for Caterpillar. Finally, Goldman Sachs. Oops, got a little typo there. Goldman Sachs, and then we'll wrap this up. Goldman Sachs over the last 20 years, only 37% of the time going higher in May. That's the lowest of all the months, and it averages going down 2%, which again is the worst going across the board. So I think those are two you want to be careful with from a seasonality perspective. And that is a wrap on May seasonality. So I know we're going to show you a poll that was, well, first we can go ahead and pull up the summary here. But there was also a poll today. Figured since we were doing the seasonality, we could take a look to see what you thought as to the day of the week. This goes back to 1950, by the way, on the S&P 500. Which day of the week is the best to be invested in the stock market? Now, if you're a long-term buy and holder, you're probably thinking, okay, who cares? And maybe you're thinking there's probably not much of a difference, but there actually is a huge difference. And can we get that poll up on the screen?
Doesn't look like quite yet. There we go.
There we go. Okay, so we got them ranked there. It looks like 195 people voted, and we got Tuesday as the number 1 day, Monday the number 2 day. Well, let me just tell you right now, Monday is the worst day, and it's not even close. Monday is horrible. Since 1950, Mondays have produced annualized returns of minus 15%, which is 24% below that 9% average. Mondays are not good, and especially Mondays after options expire. That week that I always talk about, from about the 19th to the 25th, if you get a Monday in there, forget about it. It only goes up about 38% of the time, and the annualized returns are horrendous. So that's something to think about for your trading. Short term, you might want to take those profits as you get to the end of options expiration before you get into the Monday after options expiration. Trying to pull up my numbers here just to see. Might be able to get this for you in just a second. But the winner, those 16% of you that said Wednesday, you are correct. Wednesday is the best day of, again, trying to get this day of the week. There we go. Mondays is minus 16%, by the way. Wednesdays, 19.64% annualized return since 50. That's more than double the 9% that you see throughout the year. So and by the way, Wednesday, Thursday, Friday, that's when you want to be in. Monday, Tuesday's not too bad on the S&P. Tuesday's much worse on the NASDAQ and the Russell 2000. But Wednesdays, Thursdays, Fridays definitely are the best time to be in the market throughout the calendar week.
Sounds like I should just sleep in and have 3-day weekends and forget about Monday.
Well, unless you short, you might want to short on Friday afternoon.
Good point.
Two different sides, depending on which side of the market you're on.
Yeah, that's true.
But I thought that would be interesting. I always like to do that, when I'm doing a presentation or something, just to see what everyone thinks on that Monday through Friday. Always gets everyone. Now I see Wednesday went up 17%. That's no fair. Everyone's cheating now.
Exactly. It'll be interesting to see how this poll goes through the day. How many people end up watching the rerun and voting the right answer.
Exactly. All right. So we move on now to the 10 and 10.
Indeed. I have about 35. Interestingly, Tom, while you were doing your seasonality report, the chat room was pretty much silent. I was really not even getting symbol requests. So people were very interested in what you had to say on seasonality. So I thought I'd let you know that.
I think that stuff's really important. I mean, sometimes I scratch my head. I look at something that's just kind of weird and I can't really explain it. And then other times it's like, wow, that's pretty important. Like with Booking Holdings, which was formerly Priceline, January through April is extremely bullish, has been for many years. I think it's the last 19 years. And then just looking at the stock technically, I mean, if you go back And look at it back at the beginning of the year, it was 1730 or 1740. Here we are at the end of April, it's 2165. It's done it again. For whatever reason, the first 4 months of the year for booking holdings or formerly Priceline tends to be very strong. Maybe it's the anticipation of the seasonal summer travel and all. But anyway, let's move on.
All right. Well, this is the RRG of these various requests that everybody had. Always find it interesting to see in what quadrant they are. Very interesting, because today we only had 2 that were in the lagging quadrant as far as the requests were concerned. So I thought that was kind of interesting. And the majority, though, tend to be in the leading category. So let's get started with the first one is RRD. But remember, everybody in the chat rooms watching live, go ahead and like symbol requests, and the most popular will be the next symbol. So get to it.
All right, let's go ahead and do this. All right, I pulled up RRD first on the relative chart so we can kind of take a look at what's going on. This is business support services, which has been going up and consolidating very nicely. And yet here's RR Donnelley, which is in the group, and it has been declining. So what you have is a pretty weak stock in what has been a pretty decent industry group. And if you go down below here, this is how it'll show up when you look at RRD relative to its peers. It has been declining for quite some time. It looks like it's starting to roll over again. RRD relative to the S&P 500, again, looks like it's trying to roll back over. And yet here's the group, which has been performing really well versus the S&P 500. So annotating this, if I was looking at this stock thinking about maybe investing, I probably would have to remind myself of a few things. First, it has been mostly declining, and relative to its peers, it's been declining. Relative to the S&P 500, it's been declining, and yet it's been in a group that's been increasing. So this one is just not one for me. I think if you get back up and can clear 950, I mean, maybe this is going to turn out to be some kind of a bottoming head and shoulder formation, but I think it's too early to get involved in this one, so I would pass. Do we have a next one, Aaron?
Yes, we do. The most popular in the room right now, let's see if it's the same as it was, MCD, McDonald's. And I know you mentioned it earlier. I don't know if we looked at the chart in detail, though.
We'll take a look at it. I mean, I like what's going on here today. I do think maybe I don't know if I pulled up. I didn't pull up McDonald's on the seasonal. I think it's okay seasonally in the month of May, but I would think that it's kind of one of those go-tos that's maybe a little bit more defensive that could do pretty well. And I think technically, you look at the volume coming in. So for me, I'm just seeing a breakout. Let's see how we finish today. But I know the market overall has pulled back quite a bit and gone negative. And yet McDonald's is making a breakout and it's holding it so far. So I think there's some positives here technically on McDonald's. And, as far as it relative to the S&P and some of the other stocks out there right now, I really like what it's doing after its earnings report, and a very, very solid earnings report, by the way.
Yes. All right. Let's see. Let's do something different. And I don't know if you went over this chart in depth, but XLE, the sector ETF for energy.
Yeah, I really like XLE. I would watch XOM pretty closely on this one. In fact, I'm going to go ahead and add that if I was really interested in following the XLE or investing in the XLE, which it has been one of the better performers recently, but XOM is, I think, 23% of it. And so anytime you got a stock that carries that much weight, I think you've got to pay attention to what's going on in that stock as well. So if I was looking at XLE, I'd have to be pulling up XOM as well. And you can see that it's really, XOM is holding back XLE. XLE is trying to get back up to that recent high, and you can see XOM is really nowhere near it. So I want to see this breakout on XOM down at the right about 81. If we can get back up and take out that recent high, I think that would be very bullish. For now, I think that there's enough strength in energy overall that the rising 20-day moving average should hold as support. So I'm okay with XLE. Just understand what you're owning, and 23% of it is ExxonMobil, and you got to get a little bit of strength there to really get this thing going.
All right. The next one is in home construction, Tri-Point Homes, TPH.
Yeah, I'm going to go back to a relative chart on TPH because this is a stock that I think has been performing pretty well relative to its group. The problem is the group itself. And I think I mentioned home builders don't typically do very well in the month of May. So you've got a stock that did make a breakout above this double top, but it's pulling back today pretty substantially, down 2.5%. Volume trends, though, on the most recent move to the upside are strong, so I'm getting some mixed signals. Here's the group pulling back, and you can see that with this recent breakout to a 2-month high, it's definitely outperforming its peers, and that shows up in this relative chart. So I think here you've got a nice stock, but in a weak group. And one of the things I think could help home builders is if the 10-year Treasury yield does back off and consolidate for a little bit. I think that would help. Although, if you pull up a long-term chart correlation with home construction and the 10-year Treasury yield, you'll see a mixed bag. You might think that if interest rates go up, home builders have to go down. That's not the case. And I think the correlation in history would bear me out on that one. But I just looking at this chart, what we need to see is we need to see a breakout in terms of relative strength of the group versus the S&P 500. So I think that is going to be a key relative resistance line, and I really want to hold this support level. I don't want to see this breaking back down to a new low. So for me, it's not as much about TPH, Tri-Point Homes, as it is about the overall group. I think if you're looking for something maybe on this chart, I would maybe connect this trend line right up in here. I think if we break back down below those recent lows at 16, that's going to be a problem.
All right. So that was TPH. Okay, the next one is going to be Brown-Forman Corp, BF/B, the Class B.
Right. Well, you got a pretty good group. This is the Distillers and Vintners. And I'm just looking at the chart here. So it's been a pretty good performer relative to its peers. It's been a great performer relative to the S&P, and its peers are doing very well relative to the S&P. So I think you got a really nice stock here. It's been trending higher. I don't really have anything bad to say here. We are trying to get a little breakout. My preference would be to get it maybe on a pullback at the rising 20-day moving average, but I think I would follow maybe the trend line that is being established here, maybe keep a stop below, say, 54, which was the recent low, with best entry on that rising 20-day moving average.
All right. The next one is, and we actually haven't done this in the 10 and 10 for a while, Alphabet, Google.
Okay, Google. Well, you can see the pretty key support there. I'm going to go back to the weekly chart, see if there was a negative divergence. Not really negative divergence, but you can see that 50-week moving average is pretty important. I also think the 1,000 level is very important on Google. And that comes in because of all these tops that we saw back in the summer of 2017. We broke out, and look at all these tests of 1,000. So we're sitting at 1,023. I think you got a couple percent to the downside with potentially about 15% to the upside. I like Google on a reward to risk basis, but I do want to make sure I keep my stop in play, because if the market rolls over, Google is one of those stocks. If the market does take a big hit, it could certainly go along for the ride to the downside. But I do like the reward to risk here, so I'd be okay with Google for now.
All right. Next one, Park Hotels and Resorts in the hotel and lodging REITs, and that would be PK. I hear PK and it's a penalty kill in hockey.
There you go. Let's see. Well, we've got overhead resistance. I mean, I like the trend here moving to the upside, so I think that's good. I always respect overhead resistance, especially in a market that's consolidating. So I like the chart, but I would be selling. I would take my money as I get closer to this level, and let's see if we can get the breakout. And in the meantime, because I do like the chart, if it were to pull back and hit that rising 20-day moving average, that to me would be re-entry time. So I think for the short term, I'd be watching maybe 28 to the downside and just under the 29.50 level to the upside.
Okay. Next one is Interactive Brokers. This is in an obviously investment services industry, IBKR.
Yeah, I think this was a relative winner. In fact, let me go ahead and pull that chart up on a relative basis. I remember looking at this thinking this is one of the better stocks in the group. Yeah, this is one I was thinking about. So you got your investment services, which has been doing pretty well, higher highs, higher lows. I know they've been weak for the past 6-7 weeks, but overall, I think we have an uptrending group. Relative IBKR relative to the group, very strong. Relative to the S&P, very strong. And the group itself relative to the S&P is not bad. So I actually like this one. I think this is a stock that you're getting that is among the leaders. It is at resistance, and it's trying potentially to put in a tail above the breakout. So if we don't get the breakout here, we could see some overhead resistance that could lead to perhaps a pullback. But I think if you got it back to around 72, 72 and a half, that would be a nice entry into IBKR.
All right. Let's look at an ETF, let's see, MOO, Vectors Agribusiness ETF, MOO. Very clever symbol.
Yes. I like the clever. Let's go back a little bit more. I'm sure we got a nice uptrend here that's just consolidating. It looks a lot like the overall market. And beautiful uptrend, pulled back. I think these lows are very significant now. So let's connect those lows for support, which is just a little bit below 60. I think we've got overhead resistance, trend line maybe to keep an eye on here. No, that's not. Let's see if I can grab that. There we go. So I think if you're looking at this, I think it's pretty clear we got a nice trend line that's been established now with 3 points, pulling back. I just think we're between maybe 59 and a half and 63, maybe 63 and a quarter. If we could take out this high, I think that would be bullish. To the downside, I'd be a buyer. Closer we get to 59 and 3/4, your reward to risk looks pretty solid there.
Okay. That does complete the 10 and 10. And we should have a list of symbols here for you to look at.
I think I have 9.
Oh, really? Oh, yeah. I forgot to give you the last one. Oh. It would be Best Buy, BBY. I get ahead of myself.
Now, I really like this group. I love this stock, but you are at a major resistance level here at 78. And again, you can see that tail. We got up above that prior high, and now we're trading below it. PPO looks great. I don't see any bad things here. Just the fact that maybe we're going to hit overhead resistance and a little bit of selling in the near term. So again, this is one that if by the end of the day it hasn't made the breakout, I would respect this overhead resistance from a short-term trading perspective. I would take the money, and then on a pullback, even just a couple bucks, maybe back just a little below 76, or you could try and hold out. Maybe we'll get a 20-day test. Those would be a couple of areas to re-enter. So I like Best Buy a lot. I really like this chart. I think off of a huge uptrend, I think it's consolidating. I expect the breakout, but I don't know if it's going to come right now. And if it does break out, if you sell it and it does make the breakout and you see the volume confirm, you can always get back in. I don't mind giving up $1 at resistance to make sure that we get the actual confirmed breakout.
All righty. And that completes the 10 and 10 to 1.
There we go.
And there are symbols. I will get these up in the Market Watchers Live chart list, which you can find by going to the blogs tab. Go to our blog page for Market Watchers Live, and you'll see the link for our live chart list right there at the top. And you can get these charts. You can click on them, save them to your own chart list. They're readily available to you. And with that, let's go ahead. I'm going to grab that screen. And let's talk to everybody very quickly about ChartCon, if I can get there. And there we go. ChartCon is coming up in August. If you want to learn more, of course, stockcharts.com/ChartCon is where you will find the information I am presenting to you right now, which is giving you the information is reducing risk in uncharted waters. This is going to be the lead for the ChartCon 2018. I think we all want to learn more about that. I know that our survey responses are always talking about how to set stops and that sort of thing. And you could find that out here at ChartCon. It's going to be excellent. You can read about what we're going to present, how it it's working. This is the main thing you should be aware of. It's actually broadcast live online. So this isn't really a conference where everybody comes to us. We're somewhat going to come to you because we will be doing this live. You'll get to keep the recordings. It'll be very similar to what we do now, but it'll be recorded so that you can have that for your library. And right now, very soon, like the beginning of next week, the end of this week, we're going to lose this early bird pricing. It's at $199. And this is a hard stop. We're not going to, that's when it will end. The early bird price at $199 will end in May 5th. So you want to get started and do that. You can read about all of our wonderful speakers that are going to be here. In fact, Tom McClellan will be there, and he's going to be with us this Wednesday, actually. So that should be very interesting.
Yeah, and it is May 1st tomorrow. Go away in May, right? So
yes,
apparently this is the risky time of the year. I'm not, as I talked
not
about.
That you totally subscribe to that.
Nope, not to that entire theory. I think getting out of the market for 6 months is just overdoing it a little bit. It's like, going to the doctor and having a little scratch and asking them to take your arm off.
Right. I think when I start to see the environment change and get more volatile like I'm feeling now, I mean, it's just a time to sort of step back and watch it a little bit, but I wouldn't pull everything out and wait. So
yeah, I just don't think, again, it's flashy. It sounds cool. Go away in May. But the numbers I have don't really back that up. And I talked earlier about the S&P 500. And yes, it does struggle a little bit in May relative to some of the other calendar months. But again, there are other areas of the market. It's not just the S&P 500. The NASDAQ does pretty well in May. And I showed you earlier, the internet stocks tend to do very well in May. Russell 2000 tends to outperform as we move through these months. Russell 2000 does very well during the month of May, better than the other indices. And with the dollar breaking out, I mean, that's even lining up for the small caps. So
yes.
just I'd be careful just following that without doing your homework.
All right. And with that, I'm going to move into our final market update. And I'm going to pull up the 2-day charts. You can see what's been going on just recently. When I woke up, the markets were all up and doing very well. We've seen this a lot, Tom, haven't we? You get the markets, they rally really nicely in the morning, but then we start to pull all the way back. And look at the S&P 500. It gave back not only all of its gains, but it's gone down even further than what we saw earlier as far as the gains. Now we're seeing really bad losses. We're down 7.86 points. The NASDAQ is also now in the negative. Looks like it may have found some support at some intraday lows as well as the Russell 2000, but both are trading lower. The TSX, similar situation, had a nice rally going on at the beginning of the day, but since lunch has been pummeled here. Everybody is getting hit very hard after lunch. We can see that Treasury yields are trending lower, currently reading at 29.42. UUP had a gap up and is now consolidating mostly sideways, though we lost some of that move. We're coming back up and right now reading at 24.10 for UUP. Commodities are higher on the day. USO is setting new intraday highs, currently reading at 13.85. Gold, big gap down, but it is coming back. And although it is still lower, we're looking at GLD reading at 124.76. The VIX is rising somewhat today, but we're still looking at a reading of 15.9. Below 16, I think we're still looking at some pretty complacent numbers as far as the VIX is concerned. And then I put the XBI, the Biotech sector fund, and you can see started off the day great. We had a really bad lunchtime, and it looks like we might be coming out of the intraday lows at this point for the biotechs. I'm going to take you very quickly to our member homepage, and we'll look at the market summary. This is another way to get what is going on in the market. All right, sector spiders, energy. the one Tom just looked at, energy and financials, the only one sectors trading to the upside. Industry indexes, natural gas, commodities, oil services, I recognize the theme there, are all doing well. We can see that they're really the only ones sitting in the positive right now. Worst, telecoms and gold getting hit the hardest. And again, with the breakout on the dollar, not a surprise to see gold taking a hit. As far as our international ETFs, Hong Kong and Singapore are the leaders, with the Hong Kong ETF up 1.3%. And the one that's getting beat up the most is Sweden. The Sweden ETF is down 1.85%. Russia down 1.2%, and Brazil down 1%. So those were the three that are suffering the most. And with that, I'm going to end our final market update. And I'm going to ask you, Tom, did you have something you wanted to add to that, or would you like to get started with the anatomy of a trade?
No, I think we can just move on. I mean, if there's one thing I would add, and maybe it's just a little follow-up on the seasonality, is that tomorrow, the first of the month, on the S&P 500, if we go back and we look at every first of the month since 1950, not the first trading day, but the first day of each month, the S&P 500 has been up almost 62% of the time. And it does produce an annualized return of 46.8%. And that's followed up with some pretty strong action on the second as well, where we see the S&P 500 move up 59.5% of the time with annualized returns at 38.09%. And if you're wondering about that 62% and 59.5%, that compares to any day throughout the year on the S&P 500. The average is we go up about 53% of the time. So clearly the first and second carry bullish tendencies. Now, again, that's tendency. If it goes up 62% of the time, it means it goes down 38% of the time. So I don't want anybody walking away saying, oh, Tom's guaranteed the market's going higher. I'm just saying, based on history, there is a tendency for the market to open up very strong during calendar months.
All right.
All right, what do you have for anatomy of trade?
Oh, let's see here. I haven't made any trades. I'll just be honest. I mean, I've been feeling not so great about the market, so I've been just holding those buy and holds. I thought I'd go through a few. I did run my scan, and I got a few of these that looked kind of interesting. So what I thought I would do is I'll show you Micron first, because that's the one that I am still holding. Don't like it for the short term, but decent dividends. I'm holding on to that at the moment. So let's look at Micron first. And then I'm going to show you another one that looked interesting to me out of my scan. All right. It's not been fun to take this ride lower, obviously, but with a buy and hold, if you've gotten in here, let's get back here so you can see. Let's look at a weekly. All right. So if you got in here back in 2016, you're feeling pretty good. I got in early 2017, so I'm feeling pretty good. I'm not, it's obviously been a rough ride on the way down, but this, like I said, this is sitting in my buy and hold pile. I think what I would do with the buy and holds, because again, I'll set really, if I set the stop, the hard stops, I pull them way back. I don't want to get out of my buy and holds until things are just really ugly, because generally I'm going to see it pick back up. And if I'm getting my dividends, I'm not feeling too awful about it. So I would say at this point, it is a buy and hold for me. If I were to see price get below that $37 area, that would trigger a stop for me. But I was in earlier. So I'd like to preserve some of that profit. It would be horrible that I have to endure what it is to go down, but it's a long-term hold for me. It's an intermediate term hold for me. So at this point, if you're holding Micron, I'm continuing to hold it. My concern spot, the place I would be just ready to toss in the towel, would definitely be around $37. So I thought I would just show you, where I stand on a buy and hold. And I know a lot of people ask me about that. Another one that I'm in as a buy and hold is Philip Morris. And I am still holding this. This is why I don't look at my portfolio every single day, because you look at something like this and, oh man. But it's, again, I'm looking at this in a longer term picture. So I need to be looking at a weekly or at a monthly chart. And, I'm right now, this one, honestly, I've been holding this since like 2010. So let me see what we're looking at on a monthly chart. If I can find one. Well, let's, I think I have a DP. There we go, a DP monthly chart. Okay. Yeah. So, yeah, I've been holding this since like 2010. So for me, if I start, we're obviously very near what I would call a stop point, which is right around that 77, 75. So actually, I need to go probably look at my portfolio again and make some evaluations there. It's a consumer staple. I believe it's in the consumer staple, the tobacco area. Tom, you just told me I feel a little bit better, because I think you just said the tobacco industry is looking decent going into May, June, July. So hopefully we'll see.
Yeah, seasonally, tobacco stocks, that is the best industry group when you look at May performance. And it makes sense, because May tends to favor those consumer staple companies, and of course Philip Morris in that space. So yeah, we're oversold. The stock's gotten hit really hard of late. I would not be surprised to see a rebound in the stock in May.
Yep. So I think we're at that spot. But if I, like I said, I need to go take another peek at it, because my longer term stop would be right about here in that 75 to 80 range. We're already down testing that 80 range. So I think I'm going to go back in, and I'm going to make sure my stops are set correctly. So at this point, I don't think I have a hard stop in play, but I think I will probably put one in right around the 75 range, because I think we still might have to deal with some pullback here. But I know this is the hard part for these intermediate and long-term holds, especially. Typically, if I'm buying it and holding it for the long term, I'm really gonna just, not pay that close of attention to it, because ultimately, I want to ride out, of course, the bull market moves. Eventually, we're going to hit these bear market setups and corrections. And the thing is, with a long-term one, you kind of have to ride that out to some degree. And at this point, I'm feeling okay. I certainly would have liked to have sold it way up here, but now I'm starting to get into that area where I need to preserve profits that were gained from back here. So that's what I would be looking for. So as far as my stops and the trades when I make them, I'm looking at them more. If the intermediate to longer term setup, I have those in play. We are in this bear market kind of situation. And so it's time to sort of reevaluate and get in there and make sure my stops are set so that I can preserve some capital in case this does turn into something more than a big time correction. I hate to take these losses, but it's a buy and hold, and that's why I'm in it, and I'm going to hold out until I can see that I'm just, I don't want to lose any of the profits that I gained from back here. I hate losing that profit, but it happens now and then. And I think I just had one other one that I was going to look at. It was also requested for 10 and 10. And this one I'm not holding. This one would be the anatomy of a trade as a possible trade coming in. And, we've set a whole new boundary here as far as support. So this would have come on my radar. In fact, it did. It came up in my scan today. And so this would be one that I might consider. The only issue is that reward to risk area, but I think at this point you could tighten that stop up. If I were to get in at this point, it'd be right around 11 that I'd set my stop. I would, of course, be hopefully getting into the $14.50 to $15 level for my target. But that's how I get in on a shorter term trade. And I think, people are familiar with that from just sitting through the Monday setups. But I'm going to pass it to the real trader over here. You've got a few more minutes, and take it away.
All right. Well, the first one I wanted to talk about was OTEX. I got three here. I've got one that worked out, one that didn't work out, and then one that I'm in that's kind of watching pretty closely right now. So the first one, this is one that did work out just recently, actually on Wednesday of last week. You can see the volume come in on this candle where we went all the way up to 36.50. Note that we failed right at resistance, came all the way back down. But it was this day when we went back into gap support area and then started to reverse. So I actually had a buy-in at 34.77, I believe. It was a stop buy, kind of like a stop sell, except if it came back up through that level, I wanted to get in. So if you inspect here, I think it was 34. Yeah, 34.76 was the open here. That was where we had gapped up to. So when we went down on Wednesday, we got down as low as 34.59. And when we went down and started moving lower, I actually put in a stop buy in case we came back up and took out that 34.76 level. We did it. And on Friday, when it hit the resistance, I just took a small gain and moved to the sideline. So that was just an opportunity for a quick trade. This stock is on my strong earnings chart list. And as a result, it was an opportunity just for a quick trade. But again, I'm not expecting, or I'm not going to hold and wait to see if I get above that most recent high. I was going to have a very tight stop on it to the downside and then just try to get about $1, $1.25 out of it to the upside, which I was able to do. That one worked. Now for one that didn't work, this one I was trying to get a bounce prior to earnings off the 20-day. You can see we made a nice breakout here, pulled back, hit the 20-day moving average. That's when I got in. The close below the 20-day moving average, I got out. I knew earnings were coming up in a couple of days. And by the way, you can see what has happened with earnings. This is why I don't like to hold into earnings. Stock has now dropped about $12 since its earnings report came out. Those types of losses are hard to make up. But this one was a small loss. I think it was 1%, might even been less than 1%, but it didn't do what I expected it to do. And looking back at it, probably with that breakout in light volume, I try to learn from these trades. That would have been a little bit of a warning flag. Maybe I probably should have held off and maybe not made that trade. But you pay your tuition every day in the market.
And sometimes it's more expensive than others.
Yeah, sometimes I go to Princeton and Harvard. Here's Ryanair Advanced Materials. I think I mentioned last week I was in this one. I've got a stop on a close below gap support. We had a nice gap up here, a nice move higher on some pretty good volume, reversing candle. We've been consolidating. This day I was watching, actually both Thursday and Friday, watching closely. We have not closed below that support level, which was at 21.23. We closed at 21.30. You can see intraday, we definitely went down below those levels. But this one does show some pretty good volume, and I'm thinking we're going to go back higher. So I like this one. My target, if we get up to 22.50, I'll be out. And that is what I have for the anatomy of a trade. So let's quickly get a summary. And we got Erin's trades or stocks that she took a look at, and then 3 different trades, a gain, a loss, and I'm still holding. Let's see what happens.
Yes. Yeah, it was interesting. Somebody in the chat room said, as long as every trade doesn't turn into a buy and hold, right?
As a trader, that's what you don't want to do. You don't want to be trading and then say, well, I think I'm going to buy and hold this one, because that's what happens when you get behind. So just be careful not to convert involuntarily.
Exactly. And somebody mentioned GE, that would have been a whole bad buy and hold. Well, I mean, that's why you have to have some thresholds, on your buy and holds.
All right, what do we got? We got to get running here, but what do we got for this week?
This week we have, it's going to be so great. We have monthly DP charts. I'm going to do that instead of the DP report, since I didn't do that today. Tom McClellan will be here Wednesday, and Bruce Frazier, Mr. Wyckoff, will be here on Thursday.
We got a great week coming up for sure. And thanks to everybody for being with us today. Please remember to complete the survey as you exit. I actually would love to hear what you thought of the seasonality presentation. I'm going to try to do that once a month, but we do love to get your feedback and hear what you think of Market Watchers Live. Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Monday afternoon, everybody. We'll see you back here on Tuesday. Happy trading.